Title: Silicon Valley Bank. How one collapse shook the entire tech world in early 2023. A quiet storm began brewing in the halls of a seemingly invincible institution, Silicon Valley Bank. Known as the Bank of the Tech Elite, SVB was the go-to lender for startups, venture capital firms, and innovation-driven founders. It was the lifeblood of the Silicon Valley ecosystem. But in a matter of days, this powerhouse collapsed, and with it, the trust of an entire industry. How does a bank with over $200 billion in assets fall apart so fast? How did regulators miss the signs? And more importantly, could it happen again? Let's start at the beginning. Silicon Valley Bank wasn't a household name like Chase or Bank of America. But in the tech world, it was everything. If you raised a Series A, your investor probably told you to park your money at SVB. They understood startups. They provided flexible credit. They moved fast. But beneath the speed and innovation was a flaw, one so classic. It's been in the textbooks for centuries. Concentration and duration mismatch. SVB took in billions in deposits from startups during the 2020 to 2021 tech boom. With few immediate lending opportunities, they bought long-dated treasury bonds considered safe. But there was a problem. These bonds were locked in at low interest rates. When the Fed raised rates to fight inflation in 2022 and 2023, those bond values plummeted. SVB was sitting on tens of billions in unrealized losses. The leadership, despite having access to highly paid risk officers and predictive tools, underestimated the velocity at which market confidence can shift in the tech world. They assumed loyalty. They assumed inertia. What they didn't count on was fear, fast, digital, and contagious. Worse, most of their depositors weren't regular folks with $10,000 in checking accounts. They were startups with millions, and over 90% of those deposits were above the FDIC insurance limit. These were smart people who moved fast. All it took was one VC email, one founder, chat group post, and the illusion of safety began to unravel. That meant, if panic started, it could spread fast, and it did. On March 8, 2023, SVB announced a $1.8 billion loss from selling part of its bond portfolio. At the same time, they tried to raise capital to shore up the balance sheet. The announcement was meant to show proactivity, but it did the opposite. It screamed desperation. The market freaked out. Venture capitalists began advising their portfolio companies to pull money out. WhatsApp groups exploded. CEOs began calling their CEOs. Founders logged into SVB and wired out everything they could. Within 24 hours, $42 billion was withdrawn. The next day, the bank failed. It was the second largest bank failure in U.S. history. Employees of SVB were escorted out by federal agents. Startups scrambled to find new banking partners. Tech payrolls were frozen. Startups couldn't pay rent. Founders cried on Twitter. Some said it was like watching the financial equivalent of COVID panic paralysis. Uncertainty. But why wasn't it stopped? Regulators had seen this before. Duration risk, asset liability mismatch. It was basic, yet no one acted in time. Some blamed lax oversight. Others blamed deregulation. SVB had lobbied for looser rules in 2018, and they got them. Critics pointed to how regional banks had escaped the kind of rigorous stress testing required of bigger institutions. But the truth is, in modern banking, speed kills. Social media, online banking, and concentrated depositor bases meant that a bank run that once took weeks now happened in hours. There was no time for backroom deals or overnight fixes. Once the money started flowing out, it couldn't be stopped. And when the dust settled, it wasn't just SVB. Signature Bank failed 2 days later. First Republic soon followed. The dominoes fell so fast, it became clear the banking system wasn't as fortified as many had believed. The U.S. Treasury, FDIC, and Federal Reserve had to step in with emergency measures to guarantee uninsured deposits just to calm the storm. But the damage was done. The credibility of the financial system had taken a hit, and trust is hard to rebuild. SVB's collapse was a wake-up call. Not just about banking, but about how fragile the system can be when tech, money, and fear collide. For every Rachel and David in 2008, there was a founder in 2023 who couldn't make payroll. For every Robert who lost retirement, there was a CTO who lost access to cloud servers and salaries overnight. This wasn't just about one bank. It was about the blind spots in fast-growing systems. The illusion of safety, the dominoes waiting to fall. It was about what happens when optimism meets complacency. So what now? If you're a founder, diversify your cash. Don't keep all your funds in one institution, no matter how trusted. If you're a policymaker, rethink what systemic risk really means. It's not just about size. It's about speed, reach, and reputation. If you're an investor, understand that hype doesn't make a bank safe. Due diligence isn't optional. It's essential, because the next collapse won't come with a warning. It will come as a tweet. One message, one screenshot, and the panic will follow. This is your signal to wake up, your lesson to act, your moment to build safer systems, not just faster ones. So more people see what really happened. Comment, we saw it coming if you watched it unfold. Share, to warn every startup founder and tech worker you know. Subscribe for more truth behind the headlines. Because in this new economy, information is insurance, and you just got your policy.